3 big reasons people fail at building business credit. Business credit is credit which is tied directly to a company's employment identification number and not the owner's social security number. Hence, a business needs to build credit to buy the goods and services it needs. Inquiries for business credit do not go on personal credit reports, so they don't affect personal credit scores. An entrepreneur's business and personal credit scores can be very different. Business credit has several advantages. With 2 separate credit scores, an entrepreneur can get 2 separate cards from the same vendor. This effectively doubles purchasing power. Business credit scores really only depend on whether a business pays its bills on time. Personal credit scores depend on payments, but also other factors like credit utilization percentages. Good business credit will help you get loans in the future. Building business credit is far from guaranteed. Not everyone gets to the finish line. There are 3 big reasons why this is, and they can all be prevented. Reason number 1, no company credibility. There are startup companies everywhere these days. They start in garages and in spare rooms. Someone has an idea and they decide to monetize it. So far, so good. But most companies fail in the first year. Often you'll hear over half will fail. According to Investopedia, it's more like 30%, but half fail in the first 5 years and 2/3 in the first 10. See investopedia.com/slide-show/top-6-reasons-new-businesses-fail. Understandably, lenders get nervous. Hence, they want a company to have more than just an idea or extra space in the attic. The business can be small, but it still needs to feel credible to lenders. Solution number 1, build company credibility. It all starts with professionalism. The business must look like a business and not a hobby. It has to have the trappings of a business. A business needs to be credible to lenders and vendors. It will need a professional-looking website and email address. Plus, business phone and fax numbers need to be listed on 411.com. Also, the business phone number should be toll-free, 800-EXCHANGE or comparable. A credible business will need its own brick-and-mortar or virtual address. A business address cannot be a post office, P.O. box, or a UPS box. Virtual office providers include Alliance and Regus. For remote areas, business owners may need to get creative. One idea is to talk to local entrepreneurs about where they have office space. A company will also need a bank account devoted strictly to it. A company must have all the licenses necessary for operating. These licenses all must be in the exact correct name of the business, with the same business address and phone numbers. Business credibility also means taxes. Register for state taxes. In some states, you will also need to register for city or local taxes. Register with the IRS. This also means selecting a business entity. A business entity is a commercial, corporate, and/or other institution. It is formed and administered as per commercial law in order to engage in business activities. This is usually for sale of a product or a service. Essentially, an entity is what allows a company the ability by law to conduct business. The IRS recognizes the following business entities: sole proprietorship, partnership, corporation, and S-corporation. An LLC is not considered a separate entity by the IRS. Business entity choices impact taxes, costs and shares, and legal liability. Sole proprietors are the same as the business they own. The owner pays the taxes on the sole proprietorship's profits. There are no limits at all to personal liability. If the sole proprietorship did it, then so did its owner. This includes all debts and obligations and any risks from actions of employees. The owner is the company. If it makes money, then so does the owner, with a 100% share. A partnership does not have to pay income tax. Instead, the business will pass through its profits or losses straight to the partners. Then the partners will include their respective share of the partnership's income or loss on their personal tax returns. The partners retain full shared liability, so they are not only liable for their own actions. Partners are also liable for any business debts and decisions made by the other partners, and all of the partners' personal assets can be seized to satisfy a partnership's debt. Partner shares vary, and they should be clearly spelled out in the partnership agreement. If shares are not specified, they are assumed to be equal. Corporations must pay state and federal taxes. They sometimes also pay local taxes. This will include paying income taxes on profits. This is the opposite of partnerships and sole proprietorships. A corporation can end up paying taxes twice, the first when it makes a profit, and the second time when dividends go to the shareholders. Within a corporation, the shareholders' personal assets are protected. Shareholders can usually only be held accountable for their investment in the stock of a company. But if an employee commits fraud or a felony under the corporation's direction, the corporate veil can be pierced. Then personal assets can be on the line. The solution is not to tell employees to commit fraud or felonies. A corporation is run by its board of directors. These people are usually also the owners. Ownership stakes are defined by which percentage of stock everyone owns. If one person has a controlling interest, over 50% of the stock, then their decisions will generally overrule everyone else's. Shareholders with smaller stakes in the corporation will sometimes band together. In this way, they can influence decisions or even eject board members. Profits are generally distributed per share percentages. However, board members can also take a salary. Corporations nearly always need a registered agent to accept service of process. Only the wages of any S corporation shareholder who is also an employee are subject to employment tax. Any remaining income is payment to the owners as a distribution. Distributions are taxed at a lower rate, if they are taxed at all. An S corporation shareholder's personal assets, like personal bank accounts, cannot be seized for the purpose of satisfying any business liabilities, like verdicts against the company. A shareholder working for an S corporation must pay him or herself reasonable compensation. The shareholder has to get fair market value. Otherwise, the IRS may reclassify any additional corporate earnings as wages. An LLC is not a separate entity according to the IRS, so it isn't taxed. Instead, its members pay individual taxes. Members of an LLC pay an employment tax on the entire net income of the business. LLC members are protected from personal liability for the business decisions or actions of the LLC. If the LLC incurs debts or is sued, the members' personal assets are usually exempt, but not always, hence the term limited liability. An LLC is another type of corporation, and the only real difference is liability rather than shares and costs. As a result, it mainly works like other corporations. Choose your business name and register it. You will most likely need to register your chosen business name with the state where the business will be. However, you may also need to register in the county and sometime the city as well. Corporations may have different rules. They usually require a unique name within the state where they do business, so you will most likely need to do a business name search. Reason number 2, cutting to the chase. You can't start at the top. Business credit building is a process. It won't happen overnight. You won't start out with a high-limit Visa card. Solution number 2, build business credit properly. Start at the D&B website and get a free DUNS number. This is how D&B gets a company into their system to generate a Paydex score. No DUNS number? Then there is no record and no Paydex score. Once in D&B's system, search Equifax and Experian sites for the business. You can do this at creditsuite.com/reports. If there is a record with them, check for accuracy and completeness. Start with trade credit, also known as trade lines or vendor credit. They are often net 30-day terms. These are credit issuers who will give you initial credit when you have none now. Not every vendor can help like true starter credit can. Net 30 accounts must be paid in full within 30 days. Net 60 accounts must be paid in full within 60 days. Unlike with revolving accounts, there is a set time when you must pay back what you borrowed or the credit used. These are vendors that will grant an approval with minimal effort. You also want them to be reporting to one or more of the big 3 CRAs, Dun Bradstreet, Equifax, and Experian. You want 5 to 8 trade credit accounts to move on to the next step, which is revolving store credit. You may have to apply more than once to these vendors, and you may need to buy some things you don't need to prove you are responsible and will pay on time. Consider donating unwanted items to charity. Here are 3 true starter vendors. Uline Shipping Supplies, online at uline.com. They report to D&B. Quill Office Supplies, online at quill.com. They report to D&B and Experian. And Granger Industrial Supply, online at granger.com. They report to D&B. With 5 to 8 or more vendor trade accounts reporting to at least one of the CRAs, move on to revolving store credit. These are companies like Office Depot and Staples. Use the company's EIN on these credit applications. Are there 8 to 10 accounts reporting? Then move on to fleet credit. These are companies like BP and Conoco. Use this credit to buy, repair, and maintain vehicles. Make sure to apply using the company's EIN. Have you been responsibly handling the credit you have up to this point? Then move on to cash credit. These are companies like Visa and MasterCard. Keep your Social Security number off these applications. Use your employment identification number instead. You can't start with cash credit because they may have requirements. These requirements can be a minimal paydex score, a required time in business, a certain number of trade lines reporting, often 10 to 14, or a high credit limit reporting, often $10,000 or more. Reason number 3, trying to game the system. Ethics matter. Cheating the system can only hurt you. Taking unethical shortcuts is just plain wrong, and you will be caught. One way business owners try to game the system is by buying shelf corporations. A shelf corporation is aged, so it looks older. But CRAs and banks these days will look at the date ownership was transferred, so you won't get a time in business boost this way. Another way to try to cheat the system is by buying CPNs, a credit privacy number or credit profile number. CPN, SCN, or secondary credit number is a 9-digit ID. It can be used as an identification number for people when needing extreme privacy. Like a Social Security number, a person can only have one CPN. It's used as a unique identifier for your financial transactions and lets lenders and credit reporting agencies keep an eye on your borrowing history. People buy CPNs because they want to get out of using their Social Security numbers, but you're not required to give a lender your Social Security number when applying for credit. You can withhold any identifying information from your lenders, but they can also choose to deny your application as a result. But you can't legally misrepresent your Social Security number. You cannot use a CPN in a form field which asks for your Social Security number. If you choose to withhold your Social Security number from a lender and you wanted to not become a criminal, you can leave the Social Security number box empty. If you put a CPN or another fake 9-digit number in the Social Security number field, you will have just committed a federal crime. Another way people try to game the system is by buying business trade lines. There are many companies online which promise to sell seasoned trade lines. If your company has poor or little credit, you can, for several hundred or several $1,000s, have your business piggybacked onto the account of someone with established excellent credit. Therefore, new business owners seem to be more creditworthy than they really are. Piggybacking uses a creditworthy borrower's accounts to improve the credit of an unrelated third party. A creditworthy borrower adds the third party as an authorized user of his lines of credit, but he or she does not actually provide the third party with materials, credit cards or account numbers, etc., that would let the third party make charges against the account, so the authorized user never actually uses the credit. A company offering the piggybacking service maintains a network of creditworthy cardholders or vendors. They stand by ready to add strangers to their accounts as authorized users for a fee. A third party looking to increase their credit score contacts the company. The company then offers a selected trade line to the client and charges the client a fee per account. The FBI has found that the trade line company can be a fake and the primary cardholder can be a stolen identity in these kinds of scams. Solution number 3, don't cheat the system. Apart from the ethics and keeping a clear conscience, these schemes are expensive and they don't work. And if the FBI knows you're a part of one of these schemes, you could have committed a federal crime or two. A federal penitentiary is not somewhere you ever want to go to. Let's recap. Not everyone can succeed at business credit building. There are many reasons for failure, but these are the big 3. The first is failing to build company credibility. Company credibility gives lenders assurances. You look like a business and not just a hobby. The second big reason is trying to jump the gun. Business credit building is not an overnight process. Doing the steps out of order will add delays and frustrations. The process has a particular order. That includes being active while time in business is increasing. The less said about unethical practices, the better. Just don't do them. Contact us today to learn more about 3 big reasons people fail at building business credit.